Investing 101: How to Start Building Wealth the Smart Way. Welcome. Today we're talking about investing, what it is, why it matters, and how you can get started, even if you're brand new to the world of finance. Let's begin with the basics. What is investing? Investing is a process of putting your money into assets like stocks, bonds, real estate, or mutual funds, with the goal of growing that money over time. Unlike saving, where your money sits safely in a bank account, investing involves some level of risk. But that risk comes with the potential for higher returns. So, why should you invest at all? Because inflation slowly reduces the value of your money. Over time, the cost of living increases. If your money isn't growing at least as fast as inflation, it's actually losing purchasing power.
Investing helps you stay ahead and build long-term wealth. Now, let's talk about the different types of investments you might encounter. One of the most common is stocks. When you buy a stock, you're buying a small piece of a company. If that company performs well, the value of your stock can rise. Stocks can offer high returns, but they also come with higher volatility. Then there are bonds. Bonds are like IOUs. You're lending money to a government or corporation, and they pay you interest in return. Bonds are generally less risky than stocks, but offer more modest returns. Next, we have mutual funds and exchange-traded funds, or ETFs. These are investment vehicles that pool money from many investors to buy a mix of assets, like stocks, bonds, or both. The key difference? Mutual funds are typically actively managed and priced once a day, while ETFs trade like stocks on an exchange and usually have lower fees. Both are great for building a diversified portfolio, especially if you're just starting out. Diversification is another important concept in investing. It simply means not putting all your eggs in one basket. By spreading your investments across different asset classes, like stocks, bonds, and real estate, you can reduce your overall risk. If one investment performs poorly, others may help balance it out. Risk tolerance is how comfortable you are with the ups and downs of the market. If watching your investments fluctuate stresses you out, you may prefer more stable, lower-risk options. On the other hand, if you're investing for the long term, say 10 years or more, you may be able to handle more volatility because you'll have time to recover from short-term drops. Your investment timeline also matters. Are you investing for something in the next few years, like a home or education? Or are you planning for retirement that's decades away? Shorter timelines usually call for more conservative strategies. Longer timelines can handle more aggressive growth. So, how do you actually get started?
Step 1 is building a solid financial foundation. That means paying off high-interest debt, like credit cards, and creating an emergency fund, typically 3 to 6 months of living expenses, saved in a liquid, accessible account. These steps help protect you in case of unexpected events, so you won't need to dip into your investments prematurely. Next, open an investment account. This could be a retirement account, like a 401 through your employer or an IRA, or a taxable brokerage account for non-retirement goals. Many platforms today make it easy to get started with just a small amount of money, often with low or no account minimums. From there, consider starting with broad market index funds or ETFs. These track a large segment of the market, such as the S&P 500, and can offer instant diversification with just one purchase. Also, consider using dollar cost averaging, investing a fixed amount of money at regular intervals, like every month. This approach helps reduce the impact of market volatility and takes the emotion out of investing. Over time, it can lead to better outcomes than trying to time the market. Now, let's talk about mindset. Investing isn't about getting rich quick, it's about building wealth steadily and responsibly. Markets will go up, and they'll go down. That's completely normal. The key is staying focused on your long-term goals and avoiding emotional decisions based on short-term market swings. One of the best habits any investor can develop is consistency. Whether you're investing $50 or $500 a month, doing it regularly, and sticking with it, can lead to significant growth over time thanks to the power of compound interest. That's when your money earns returns, and then those returns start earning returns of their own. It's like a snowball that gets bigger the longer it rolls. Another good practice? Keep learning. The world of investing is always evolving. New technologies, trends, and tools are changing how people manage their money. But the fundamentals, diversify, invest consistently, think long-term, those remain timeless. And finally, don't worry about being perfect. Thanks so much for joining today.